Investors have been largely optimistic about the outlook for airlines as consumers anticipate resuming travel in the post-COVID era, and already have in large part. But could the looming threat of a recession and the destruction caused by Winter Storm Elliot and resulting flight disruptions cloud investor sentiment? Here to weigh in on the outlook for airlines is Moody's Senior Vice President Jonathan Root. Jonathan, thank you for being here. Appreciate it. I have to start with Southwest because of what we have been seeing over the past several days. And I'm just curious, as you look at it, how much of a problem is this going to be going forward for Southwest? How much money is it going to have to spend to address some of what seem like sort of system problems?
Sure. So we think Southwest will be fine at the end of the day. This is a terrible event for them. It highlights a shortcoming in their IT systems and managing the staff. The most important thing for the operation is knowing where your pilots and flight attendants are, where they need to be, and getting them there.
And they don't seem to know.
And unfortunately, for them, and I'm sure it's an embarrassment, their systems are not allowing them to do that. From a cost perspective, I think it's going to be hundreds of millions of dollars. If you go back, one example, 2017, April, 24-hour thunderstorms in Atlanta. Mm-hmm. And Delta had to cancel 4,000 flights. And that company at that time disclosed $125 million hit to their operating profit because of that event. So that's the only marker we have. So for the industry, I'm going to guess it could be a $750 million hit to earnings in the fourth quarter. Southwest will bear the brunt, but they're going to be fine. They're going to focus. We can all appreciate they're going to focus on fixing this so this never happens again.
Okay, and so the cost to fix, in addition to the cost that's already been incurred, when we think about kind of the net impact of what that actually does to sentiment for flyers too, and the future costs for realized revenue, all in, I mean, if we were to put a dollar figure on the total that we could be looking at for an impairment for Southwest, for what they're going to be charged in terms of some of the investigations that are going forward, the costs that they have to put forward, then what they're missing out on in future revenue from customers. What does that even look like?
Yeah, very hard to quantify. Still feel the company will be fine, right? The brand has taken a punch, whether it's a kick in the shin or a gut punch. But the company, very confident they're going to recover. These companies, airlines, they know how to manage IT systems. I'd say for Southwest, it appears that it didn't upgrade this one as timely as I'm sure it now wishes it had. Mm-hmm. IT systems, the company is going to spend $1 billion a year on non-aircraft. It's been spending at that level. So the costs are very manageable. In terms of the hit to revenue, right, there's going to be immediate compensation for people that were disrupted. There may be, low fares and, specific offers to folks on the list who they know were disrupted. So it'll be a hit. Look, we're expecting $2 billion of operating profit at Southwest in 23. So it's hard to quantify, but from our view, there's a large cushion to manage. So even if it's 1.5 instead of 2, the company will be fine in that regard.
Like other airlines, here's a company that feasts on debt, over $10 billion in total debt on their balance sheet. What does this event mean to their credit profile, and how much more cost does it add onto them just when they raise further debt? What does it do to their cost of capital?
Yeah, the cost of capital at Southwest will not be impacted. The company has $13 billion of cash at the moment, more cash than debt. It has no needs to raise debt. It will pay cash for its aircraft deliveries. Those are slowed at the moment because of the challenges in the aerospace supply chain. Boeing cannot deliver to the contracted schedule. So we don't expect any impact to its credit profile. We have the company at Baa1 with a stable outlook. And while this is an unfortunate event for the company, it should not impact its credit given its very strong liquidity and its historical brand that will recover from this.
Given the structural operating issues that have now come to light for Southwest, what's the reality that they actually get back to full capacity that they were talking about reaching in 2023?
Yeah, I don't think this derails it materially. The challenge is this was an event, a storm with wide geographic scope that just impacted all operations at all airlines. Again, the most important thing is knowing where your pilots and flight attendants are and getting them to that place. And when most of your aircraft are in places that are down because of, the weather and the challenges, and you can't move the people, it's a challenge. So we are not ready to mark down our, capacity forecast for Southwest because they will recover. If another storm like this happens 2 weeks from now, then, I think we're going to be reminded very quickly that, this operation
Right.
is subject to these one-time events, but we don't think it is a secular or structural feature that's going to impact the company.
Yeah, it's really just interesting because it feels like that capacity, in this event elucidated that capacity was really based on some of the operating procedures that they have in place right now, continuing to move forward. So it is a question of how much they're going to be spending going forward to course correct on that. We do have to leave things there for right now, but pleasure to have you here with us in studio today. Moody's Senior Vice President, Jonathan Root. John, thanks for the time.